Modern trading is defined by speed. High-frequency algorithms process sentiment data and volatility clusters in milliseconds, executing massive liquidity sweeps in the blink of an eye. To navigate this environment, a trader needs serious processing power. Yet a massive portion of the retail market still relies on a 32-bit operating application from 2005, MetaTrader 4. The gap between MT4 and MT5 has shifted from a matter of user preference to a technical liability. Modern liquidity providers now prioritize MT5's fixed gateway, leaving legacy users with a built-in latency disadvantage. This technical debt carries a high price. We are going to open the hood on this legacy software to expose the 3 specific bottlenecks that restrict a trader's asset classes and execution speed. The first bottleneck is raw memory. MT4 is a 32-bit application, which places a hard cap on the amount of RAM it can address. MT5 operates on a 64-bit architecture, allowing it to process massive price update arrays significantly faster. During a high-impact news event, like a surprise central bank rate hike, the price feed can update hundreds of times per second. MT4 often freezes or lags during these quote storms, while MT5's 64-bit architecture stays fluid, ensuring orders are processed in real time. Most modern CPUs have up to 32 cores, yet MT4's single-threaded strategy tester forces massive optimization tasks through one narrow pipeline. MT5 shatters this limit, using every core simultaneously and tapping into the MQL5 cloud network's decentralized nodes. A complex genetic optimization that would take 48 hours to complete on MT4 can be finished in just 15 minutes using this distributed network. In 2026, this speed is the difference between identifying a market regime shift in real time or discovering it after the opportunity has passed. The second major bottleneck is market access. MT4 was built exclusively for the decentralized Forex market. To see the rest of the financial world, the software is functionally blind. To trade stocks or futures on MT4, brokers use third-party bridges to translate commands. Each bridge acts like a toll booth, adding latency as the packet changes shape. This delay creates tangible slippage, costing traders dollars per lot. MT5 removes the middleman. It was designed for multi-asset trading from day one, offering direct market access without the need for translation software. This architecture allows for native connections to centralized exchanges, like the CME Group, ensuring near-instant execution for futures and stocks. This direct connection also provides access to real volume data. While MT4 users are limited to tick volume, a proxy based on price movement, MT5 users see the actual number of contracts being traded on the exchange. The final bottleneck is the language itself. To understand why MT4 struggles with modern expert advisors, we must look at its underlying code. MT4 uses MQL4, which is a procedural language. It functions like a linear, rigid scroll of instructions. Because the code is linked in a single chain, changing one instruction can inadvertently break your entry signals. MT5 utilizes object-oriented programming. Think of MQL5 like a set of Lego blocks. You can swap out a risk management block for a new one without touching your entry signal block. This modularity allows MT5 to handle complex data structures natively. It can plug in Python-driven neural networks and large language model sentiment analysis directly into the execution logic, tasks that MQL4's linear architecture wasn't designed to handle. Attempting to force these data-heavy AI models through MQL4's procedural constraints creates a computational ceiling. It limits the complexity of the strategy and, by extension, the trader's ability to compete with modern algorithmic firms. There is also a macroeconomic reality to consider. MetaQuotes has stopped selling new MT4 server licenses. We are now in the sunset phase of the software's lifecycle. This means brokers now pay a significant premium to maintain old MT4 servers, which lack the modern security protocols built into the MT5 core. To cover these rising maintenance costs, many brokers are widening spreads or increasing commissions specifically for MT4 accounts. In 2026, a trader might pay 0.2 pips more on USD simply for using the older platform. By refusing to migrate, traders are voluntarily accepting slower execution, inferior backtesting, and higher transaction fees. It is time to trade in the present. Download the FXNX MT4 to MT5 migration guide and open an NX1 demo account to experience the difference of a 64-bit engine with 0.0 pip spreads.